Hello everyone. Today we are going to cover the second chapter and a very important chapter of conceptual framework, that is the qualitative characteristics of useful financial information. Our Bible document, the conceptual framework, does not just guide us on what to report in the financial statements, but also emphasizes how financial statements should be prepared. When you study IAS and IFRS, the conceptual framework tells you what is required of you and what qualities are essential in the financial statements you prepare. Now, when you grow up to be a financial expert and prepare financial statements, those statements should not just be an ordinary documents. They need to possess certain qualities, good qualities that elevate them to true financial statement. Without these qualities, no matter how well you format those statements, they are essentially junk. They may look good, but they will not be considered true financial statements according to the conceptual framework. The conceptual framework outlines two types of qualitative characteristics. Number one, fundamental qualitative characteristics, and number two, enhancing qualitative characteristics. Let's break them down. Let's begin with the fundamental qualitative characteristics, which are mandatory. These characteristics form the core qualities that financial statement must possess to be considered reliable and effective. Think of it this way, that financial statements may appear to be just 5 pieces of papers. One for the statement of comprehensive income, one for the statement of financial position, one for the statement of cash flows, one for the statement of changes in equity, and one for the notes to the financial statements. But they are not just 5 pieces of paper. Financial statement must embody fundamental qualitative characteristics to hold any value. Without these, they are nothing but a waste of time. When auditor assesses these statements and issue an audit report, they are looking for these fundamental characteristics to ensure that the statements provide a true and fair view. If the fundamental characteristics are missing, the financial statement cannot be trusted no matter how polished they look. Now, my friends, there are two fundamental qualitative characteristics you must remember. Number one, relevance, and number two, faithful representation. Say it with me 3 times. It is the golden rule for remembering. Relevance and faithful representation. Relevance and faithful representation. Relevance and faithful representation. Next, we have enhancing qualitative characteristics, which are voluntary. While fundamental characteristics are mandatory, enhancing characteristics are nice to have. Enhancing in itself means which further improves. So it makes the information further useful, right? In today's business world, investors increasingly demand enhancing characteristics, but they are not an absolute requirement under the conceptual framework. These characteristics add value to the financial statements, but their absence does not render the statements invalid. If the fundamental characteristics are in place, the financial statements are already acceptable. Enhancing characteristics simply elevate their quality. Now, my friends, let's dive into the first fundamental qualitative characteristics, that is relevance. Relevance in financial reporting is all about providing information that meets the decision-making needs of users. It ensures that information presented is meaningful and capable of influencing decisions, whether those decisions are about investing, lending, or other forms of resource allocation. Relevance in financial reporting means that all relevant financial information that is capable of making a difference in the decisions made by the users should be included in the financial statement. Financial information is capable of making a difference in decision if it has predictive value, confirmatory value, or both. Relevant information helps user evaluate and make predictions about future events. For example, by looking at trends in revenue and profit, investor can predict whether the company will grow and remain profitable. And relevant information also allows user to confirm or correct their past evaluation. For example, if someone predicted that the company would grow by 10% this year, financial reports can confirm whether that prediction was accurate or if it needs to be adjusted. Here is the interesting part. Predictive and confirmatory values are interrelated. This means that the same piece of information can serve both purposes. For example, if a company reports higher profit this year, it confirms last year's prediction that profit would increase. At the same time, it helps user make new prediction about the next year performance. So relevance is not just about giving numbers. It's about giving information that makes sense, that can be trusted, and that helps user look forward while also evaluating the past. That's what makes the financial report so important. Also, let me clarify something very important. Financial statements are not a newspaper. A newspaper might report everything from when Mr. Murtaza arrived at 8 a.m. in the morning to how a 15 minutes delay caused productivity issues. Financial statements, however, are not meant for such insignificant details. Instead, they should include only the information that matters, the information that could make a difference in the decisions of the users, information that is capable of influencing the decisions of the users of the financial statement. Now, when we talk about relevance, we must also discuss materiality and how it affects the relevance of information in financial reporting. Materiality is a fundamental concept because it determines what information matters enough to be included in the financial statement. The basic idea is this: information is considered material if omitting it or presenting it incorrectly could influence the decisions made by the primary users of the financial statement. Now, here is something important to remember. Materiality is not a one-size-fits-all concept. It is entity-specific and depends on nature or magnitude of the information, or sometimes both. For example, $100,000 expense might be material for a $1 million company as it represents 10% of the company's equity. However, the same $100,000 expense would be immaterial for a $10 billion company and might not need to be reported separately. This shows that magnitude matters when determining the materiality. Similarly, imagine a $1,000 fraud in a $100 billion company. By magnitude, this is not material. But what if the fraud was committed by the director, a person charged with governance? Now, the nature of information makes it highly material because it raises serious concern about the company's leadership and the internal controls. Such incidents must be disclosed regardless of the amount involved. Let me share one more example to make it clearer. Imagine a company sells one of its properties for $4 million during the year. Now, whether $4 million is material in monetary terms depends on the size of the company. If the company is a large corporation with billions in revenue, $4 million might seem small and immaterial based on its magnitude. But for a small company, $4 million could be huge and material based on its size relative to the business. But wait, materiality is not just about numbers, it is also about the nature of the transaction. In this example, let's say that the property was sold to another company owned by the company's chief executive officer. Now, even if $4 million is not big enough to be material based on magnitude, the fact that it is a related party transaction makes it material by nature because it raises concern about transparency and fairness. This is why materiality does not have a fixed threshold that applies to every entity. It requires professional judgment to assess whether information should be disclosed based on who is affected, what is the context, how does it impact decision making. To help companies make better materiality judgments, the ISB has issued an IFRS practice statement called Making Materiality Judgments. This document provides guidance but not mandatory rules, allowing companies to exercise judgment while ensuring consistency and transparency in disclosures. So in simple terms, materiality is all about focusing on what really matters, whether it is about big numbers or sensitive information that could impact users' decision. It keeps financial statement relevant, clear, and trustworthy. Alright, my friends, you have already discussed the first fundamental qualitative characteristics, that is relevance. Let's now talk about the second fundamental qualitative characteristics, that is faithful representation. The term faithful representation simply means that the financial statement should reflect reality. They should show what's actually happening in the business. The numbers, the transactions, and the disclosures must match the economic substance of what's actually going on, not just the legal form of the transaction. For example, let's say you sell an item of inventory to another party with an agreement to repurchase it later at a fixed price. Now, legally, it appears as a sale transaction, but in economic reality, but as per the substance, it is a financing arrangement because you are retaining the ownership risk and rewards. So you have to treat this transaction as secured borrowing under IFRS 9 financial instruments and not as a sale under IFRS 15. That's what we mean by reflecting substance over form. And this concept plays a big role in ensuring faithful representation. Faithful representation ensures that all relevant financial information is not just included, but is represented in a way that is true, fair, and reliable. Think of it this way. You don't just provide relevant information, you ensure that the information is presented accurately and honestly. It is like making sure that the story you are telling with your financial statement is complete, unbiased, and accurate. Now, to achieve faithful representation, financial statement must meet three key characteristics. Number 1, neutral. Number 2, complete. And number 3, free from error. Let's repeat this together to make it stick. Neutral, complete, and free from error. Neutral, complete, and free from error. Neutral, complete, and free from error. Now, let's break down these three aspects that makes information faithfully represented. First of all, neutrality means that the information presented in the financial statement must be free of bias. It should not favor one outcome over another just to make the business look better or worse. And to achieve this, we apply the prudence principle, which means being cautious when making estimates under conditions of uncertainty, such that asset and income are not overstated and liabilities and expenses are not understated. Let's take an example from IS2 inventories. If the net realizable value NRV of inventory drops below its cost, you must immediately recognize a loss. But if you expect a profit, you wait until it is earned before recognizing it. This cautious approach prevents businesses from overstating their assets and income or understating their liabilities and expenses, which could mislead the investor and other creditors and other users. The same principle applies to IS 36, impairment of assets. If there is any indication that an asset's value has dropped, the company must test for impairment and recognize an impairment loss if required. Again, this ensures that information in the financial statement is presented objectively without favoring any particular outcome. Then, faithful representation also means that information must be complete. Nothing should be left out that could make the financial statements misleading. For example, IS 16 property, plant and equipment requires companies to include all directly attributable costs when recording the cost of an asset, such as installation charges and legal fees. Now, someone might argue, why not expense these costs directly? It will all be depreciated anyway, right? Well, the problem is that doing so distorts the reality of how much the asset truly cost and affect the balance sheet and profitability calculation. That is why it is important to show the full picture, no shortcuts. And finally, the third characteristics of faithful representation is that information must be free from error. Free from error means the financial information should be reasonably accurate. It does not mean perfect accuracy in all cases. Let's clarify something. Absolute accuracy is impossible. After all, accounting involves use of a lot of judgments and estimates, which are inherently subject to error, like the useful life of an asset or the expected credit losses on receivable. However, the information must be free from material errors. Any calculations or assumptions made should be reasonable and well supported based on the available information. For example, an estimate might not be 100% correct, but as long as it is reasonable and made in good faith, it satisfies these characteristics. And if an error is identified, it must be corrected immediately, even if it occurred in previous year. This is exactly what IS 8, accounting policies, changes in accounting estimates and error requires. Go back, fix the error and update prior period so that information remains reliable. My friends, faithful representation is at the heart of reliable financial information. It ensures that information we present to the stakeholder is neutral, complete, and free from material error, giving them the confidence they need to make the informed decisions. But remember, faithful representation is not just about following the rules. It's about capturing the reality of the business and telling the true financial story. Whether it's about recognizing losses, accounting for risk, or valuing asset, the goal is always to reflect the economic substance of what's happening, not just the legal form. And that is why concepts like prudence, neutrality, and completeness play such a vital role in building trust and transparency in financial reporting. Now, my friends, we have covered the fundamental qualitative characteristics, that is relevance and faithful representation. Let's move on to the enhancing qualitative characteristics. Enhancing qualitative characteristics are not mandatory like the fundamental ones, but they improve the usefulness of financial statement. Think of them as the extra polish that makes financial statements even better. There are 4 enhancing qualitative characteristics and they are easy to remember. Number 1, comparability. Number 2, verifiability. Number 3, timeliness. And number 4, understandability. Now, let's break this down step by step. First, comparability within the same industry over time, what we call intra-company comparability. This helps user identify trends in financial performance and position. For example, if you are analyzing a company's profitability, you should be able to track whether its profits are rising, falling, or remaining stable year after year. Next, we have comparability between different entities, also called intercompany comparability. This allows users to compare one company against its competitors. Imagine you are an investor trying to decide between 2 companies in the same industry. You need consistent and comparable information to determine which one is more profitable, efficient, or financially stable. Now, how do we achieve this comparability? The key is consistency. Consistency in the accounting policies used to prepare the financial statement. For example, let's say a company uses the FIFO method for valuing its inventory. FIFO stands for first in, first out, meaning the oldest inventory costs are recognized first. If the company suddenly decides to switch to the weighted average cost method, the numbers in the financial statement will change significantly. So to preserve comparability, IFRS standards requires companies to disclose the accounting policies they use in their notes to the financial statement, clearly explain any changes to these policies and the impact of those changes, and apply the changes retrospectively, meaning they must adjust prior year's financial statement as if the new policy had always been in place, so that user can still make meaningful comparison between the current and prior years, even after a change in accounting policy. This rule is explicitly required under IS 8, accounting policies, changes in accounting estimates, and errors. Another critical aspect of comparability is corresponding information, also known as comparative information. IFRS requires that financial statements include data from prior periods. This allows users to spot trends and evaluate performance effectively. For example, if you are reviewing the company's income statement for 2023, you will also see the figures for 2022 side by side to compare the performance. Similarly, the balance sheet shows comparative figures for previous year so that changes in asset, liabilities, and equity can be easily analyzed. In practice, comparability is not just about numbers, it's about transparency and fair reporting. Even when companies operate in different industries, having common standard ensures that comparisons can still be made, especially for general performance metrics like profitability ratios or liquidity ratios. So the main takeaway is that comparability allows financial statement to tell a consistent story, whether you are looking at the past performance of the same company or benchmarking it against other companies. It ensures that same accounting policies and methods are applied year after year, unless there is a valid reason to change them. And even then, the changes must be transparent and retrospectively adjusted to preserve comparability. And remember, comparability is not just about numbers, it's about building trust in financial reporting and giving users the tool they need to make informed decisions. That is why consistency in accounting policies, clear disclosures, and comparative data are absolutely essential. Now, let's talk about the next enhancing qualitative characteristics of financial statement. That is verifiability. Verifiability is all about ensuring that information presented in the financial statement is credible, reliable, and can be checked or verified by others. In simple terms, it means that if two or more knowledgeable and independent people look at the same information, they should be able to reach the same conclusion about whether it faithfully represents what it is supposed to. This characteristics improves the trustworthiness and credibility of the financial statement. Now, verifiability can be achieved in two ways. Number one, direct verification, and number two, indirect verification. In case of direct verification, financial information can be directly observed or confirmed or inspected. For example, counting the actual inventory in a warehouse to confirm its value, verifying cash balances by checking the company's bank statement, inspecting a building or a piece of machinery to confirm its existence and condition. In these cases, you are directly observing the evidence, so it's fairly straightforward to confirm whether the reported information is accurate or not. Sometimes direct verification is not possible, especially for estimates or values derived from the models or formulas. In such cases, we use indirect verification to check whether the process or method used to calculate the value is reasonable and logical. For example, verifying the fair value of an investment property using a valuation model based on market trends and comparable sales data. Checking the depreciation expense of an asset by reviewing the depreciation formula and confirming that the input values such as useful life and residual value are reasonable and supported by evidence. Reviewing the assumptions and methods used to calculate provisions for warranty claims or legal settlements. In indirect verification, we are not looking at the actual asset. Instead, we are evaluating the process and inputs used to calculate the reported amount. Verifiability enhances the quality of financial statement because it gives confidence to the users of the financial statement. If users like investors, creditors, and analysts know that the information has been verified or can be verified, they are more likely to trust it and use it to make informed decisions. Let's take an example. Imagine a company has reported profit of $5 million this year. Investors would naturally want to know if this profit figure is accurate and reliable. They would look at supporting evidence like sales record, expense receipts, and bank statements to verify whether the companies actually earned that much profit. If the numbers can be verified, investors feel more confident about their decision, whether it's buying shares, lending money, or signing a contract with the company. Another important aspect of verifiability is disclosures. Companies don't just report numbers, they also have to explain how they arrived at those numbers. For instance, if a company revaluates its property, it needs to disclose the valuation method used, the assumptions applied, and the market data relied upon. If an estimate is made for future liabilities like a legal provision, the company needs to justify the estimate by providing details about the expected outcome and probabilities. These disclosures allow external users like auditors and analysts to verify the information. It's like showing you're working in maths class so that teacher can check your process and confirm your answer is correct. Let's say a company values its inventory at $500,000. How can we verify this? You can physically count the inventory items and match them with the quantities reported in the financial statement. Or you can review the purchase invoice to verify the unit cost of inventory and check whether the valuation formula such as FIFO or weighted average was applied correctly. Similarly, if a company reports a provision for warranty claim, you can examine historical data of warranty expense to confirm whether the estimate is reasonable, or you can review the calculation model used to determine the provision amount. This process builds trust in the reported figures and ensures that financial information is credible and transparent. Now, you might be wondering, what about estimates? Are not they based on judgments and assumptions? Yes, that's true. And that's exactly why verifiability does not require the information to be perfectly accurate. It just needs to be based on reasonable assumptions and supported by objective evidence. For example, an estimate of bad debts may rely on historical trends of customers' payment, or a calculation of useful life for machinery may rely on engineering reports or industry practices. As long as these estimates can be reviewed and evaluated by others and found to be reasonable, they meet the standard of verifiability. So verifiability is not just about numbers, it's about building trust. It's about showing users of the financial statement that the information they are relying on is credible, transparent, and reliable. Whether it's through direct evidence or logical processes, verifiability helps ensure that financial reporting maintains integrity and consistency. Let's now talk about timeliness, which is another enhancing qualitative characteristics of useful financial information. Timeliness simply means that the information must be available to the users in time, so they can use it to make effective decisions. After all, what's the point of having accurate and reliable information if it arrives too late to be useful? Think about this way. Imagine you are planning to invest in a company that is about to issue shares. You want to review its financial performance before making a decision. But what if the company's financial statement for the current year are only released 6 months later, after the investment window has closed? Would that help you? No. Because by the time the information reaches you, the opportunity to make an informed decision is gone. This is why timeliness is critical. Financial information needs to be prepared, audited, and released quickly enough so that stakeholders like investors, lenders, and creditors can act on it when it matters the most. Now, does this mean that older information is completely useless? Not at all. Even though older data may no longer be helpful for making immediate decisions, it can still be valuable for identifying trends over time, analyzing past performance to predict future outcomes, and assessing patterns of growth, profitability, or financial stability. For example, looking at a company's past 5 years of financial data can help investors spot trends like consistent growth or declining profit, and use this insight to make prediction about the future performance. However, when it comes to decision like buying shares, granting loans, or entering into contract. Recent and up-to-date information is what users rely on. Let's consider another example. Imagine a company is applying for a bank loan in January 2024, but it only submits its 2022 financial statement. The bank manager might look at those numbers and think, these statements are already 1 year old. How do I know what happened in 2023? What if the company faced a significant loss last year? What if its current assets are no longer enough to support this loan request? Did you see the problem? Without timely financial information, users cannot assess the risk or make informed decision. Now, here is an interesting question. What if providing timely information means sacrificing accuracy? For example, let's say a company rushes to release its financial statements to meet a tough deadline, but in the process, it overlooks some errors or misstates figure. Would that be acceptable? Absolutely not. Timeliness is important, but it cannot come at the cost of accuracy or faithful representation. Information must be still complete, unbiased, and free from material errors, even if it takes a longer time to finalize. This is why company must strike a balance, ensuring the information is both timely and reliable so that it meets the needs of user without compromising quality. Let's break it down further with some real life examples. Public companies are usually required to publish their annual financial reports within 3 or 4 months after the financial year end. This ensures investors and regulators have current data to analyze the performance. Many companies issue quarterly financial statements to give investors more frequent update about their performance and to announce quarterly earnings result. Public listed companies are required to immediately disclose material information like mergers, acquisitions, or lawsuits that could impact their share price. These practices reflect how companies prioritize timeliness to keep shareholders informed and confident in their decisions. Let's assume a company delays releasing its annual report by 6 months. What impact could this have? Investors might sell their shares due to uncertainty. Lenders may reject loan application because they don't have recent data to assess credit worthiness. Suppliers might refuse to offer credit terms, fearing the company's financial position has worsened. Regulators may impose fines for failing to meet reporting deadlines. Clearly, ignoring timeliness can hurt a company's reputation, relationships, and financial stability. So to sum up, timeliness ensures that the information provided in financial statement is relevant, actionable, and usable at the right moment. It complements other qualitative characteristics like faithful representation and verifiability to make financial reporting more effective. And that's why timeliness is not just about meeting deadlines. It's about building trust by giving users the tools they need to make confident decisions when it matters the most. Let's now move to the final enhancing qualitative characteristics, that is understandability. Understandability means that financial statements should be prepared in such a way that they can be understood by users who have reasonable knowledge of business and economic activities. It means that financial information should be presented in a clear, concise, and logical manner so that user can easily understand its meaning. Financial reports are not storybooks. They are technical documents meant to communicate complex economic activities and financial data. So while the information should be structured and explained clearly, it cannot exclude important or complex details just because some user might find them difficult to understand. Here is something important, my friend. Users of financial reports are assumed to have reasonable knowledge of business, finance, and economics, and a willingness to study and analyze the information carefully. So, financial statements are not designed for complete beginners. Instead, they are meant for users like investors who analyze profitability and risk, lenders who assesses repayments ability, and auditors and analysts who evaluate trends and compliance. Because these users are expected to have some financial expertise, accountants don't need to oversimplify or dumb down the reports. However, they still need to ensure that the data is organized and structured in a way that makes it easier to follow and interpret. Imagine preparing financial statements filled with jargons, mnemonics, and technical shortcuts that only you can understand. What's the point? Financial statements are meant to communicate financial information, not to confuse the users. If your investors, stakeholders, and other users cannot understand what is written, the entire purpose of financial reporting is defeated. Let's take an example to understand how standards ensure understandability through proper classification and presentation. I-16 tells us that the revaluation gain on property, plant and equipment should be recorded in other comprehensive income and not in profit and loss. Why? Because the revaluation gain is unrealized. It has not yet been converted into cash. Putting it directly into profit and loss could mislead the users into thinking that it's a regular income that impacts profitability. By separating it into OCI, the standard ensures that user can differentiate between operating profits and unrealized gain, making the information more understandable. Similarly, I-16 also requires company to review depreciation estimates every year based on changes in useful life, how long an asset is expected to last, and residual value, how much it will be worth at the end of its useful life. If these estimates change, the company must update the depreciation amount going forward and disclose the change clearly in the notes to the financial statements. These disclosures ensures that users understand why the depreciation expense changed and how it affects the company's profits and assets. Understandability is not just about the main financial statement. It also depends on notes and disclosures that accompany them. For instance, if a company changes its accounting policy, the notes explain why the change was made and how it impacts the financials. If a company uses estimates, the notes highlight key assumptions. For example, expected future cash flows used in impairment testing under IAS 36. If there is a contingent liability, like a pending lawsuit, the notes describe the nature of risk and possible outcomes under IAS 37. These explanations make the report transparent and understandable, even when they deal with complex matters. Now, this is interesting. While information should be presented simply, it cannot ignore complexity if the matter itself is complicated. For example, calculating deferred tax under IAS 12 involves temporary differences, tax bases and rates, or measuring fair value under IFRS 13 may use complex valuation models and assumptions. These concepts are inherently technical and accountants cannot escape details just to make them simpler. Instead, they provide supporting explanation in the notes, ensuring users can follow the logic even if the calculations are advanced. Now, to ensure that financial statements are understandable, avoid unnecessary complexity. Do not overload your financial statements with technical jargons or abbreviations. For example, instead of using obscure acronym, provide clear and meaningful description. Use clear formatting, proper classification and organization of financial data help user navigate the statements easily, and provide adequate disclosures. Supplement the numbers with explanations so user can understand the context. The conceptual framework strongly discourages making financial statements so complex that only the preparer understands them. Let's be blunt. If your financial statements are difficult to understand, they become worthless. Investors and stakeholders won't have confidence in your reporting. Decisions based on unclear financial statement will be flawed and you will lose the trust of your audience. So understandability is like translating financial data into a language that users can process and trust. It ensures that even the most complex transactions are communicated in a way that maintains clarity without losing depth. So as we move forward, keep in mind that financial reports are not just about numbers. They are about telling a story that helps user make smart decisions. And understandability makes sure that story is told in a way that everyone can follow. My friends, before we wrap up this session, let me share something important with you. While I have provided you with detailed explanation and examples to make things as clear as possible, the real learning happens when you actively engage with the material. Here is my suggestion. Don't just listen to this lecture or read the notes. Instead, rewrite the concepts in your own word. This will help you retain the information better. Create mind maps or summaries to visualize the connection between different ideas. Practice with examples to strengthen your application of these principles. Trust me, this habit won't just help you pass exams. It will help you master the subject and apply it in the real life scenarios as well. So now that we have explored the two fundamental qualitative characteristics, that is relevance and faithful representation, and four enhancing qualitative characteristics, that is comparability, verifiability, timeliness and understandability. I hope you have understood how these qualities add value to the financial statements. Learn these concepts by heart, practice consistently, and you will have no trouble applying them whenever needed. Let's keep the momentum going. There is more to cover, and I will see you in the next lecture. Thank you.